Hi friends, welcome to Edupedia World. I am C. Radhika Singhal. In the last session, we discussed how we are going to plan this capital structure. How this capital structure should actually be framed. So we learned that it should be consistent, it should run for a long tenure, and obviously it should be feasible. So after this planning, we come on to designing of this capital structure. So designing is different from planning because designing is only when this planning ends. So for designing this capital structure, the things that we should keep in mind is your capital structure should be functional. So by functional means you have strategy for the organization. There are long-term strategy that you want. What is a long-term objective? That wealth maximization. So your capital structure should be synergized with your long-term strategy of the organization. Moreover, we should keep that your capital structure. It should not hamper day-to-day working. For example, if you have so much financial risk that you have such a good interest burden over the company that it affects your day-to-day functioning of the organization, or your lenders, whoever the investors are there in the organization, they have imposed certain restriction that's actually affecting or hampering your day-to-day function. That should not be the formation of a capital structure. So this should be kept in mind that your capital structure is functional. Next thing, it should be flexible. Flexible, and I mean like it's not practically that company got some good project. So company might have to expand its capital structure. So your capital structure should adjust in the expansion, and likewise if there is any contraction in the capital structure, the capital structure should be like that. It should be flexible enough to adjust both the contraction or temporary contraction, or you can say the temporary expansion in the business organization. And the third thing, it should be conforming statutory guideline. For example, a lender has imposed certain restriction that your debt cannot be increased beyond this limit, or there are certain statutory guidelines also from SEBI and all. So it should be framed that it is in conforming all these statutory guidelines, or it is in line with the obligations that the company has. These are the basic things, like if you are also designing the capital structure of an organization. Let's discuss that. I'm giving you one situation and you tell me that which plan is very suitable for the company in such scenario. ABC Limited has equity share capital of rupees 5 lakh divided into shares of rupees 100 each. It wishes to raise a further of rupees 3 lakh of expansion. The company plans the following alternatives. First, it could expand by issuing equity shares only. Second, rupees 1 lakh by issuing shares and rupees 2 lakh through debentures at 10%. Third, by raising term loan 10% per annum. And fourth, rupees 1 lakh by issuing equity share and rupees 2 lakh by issuing 8% preference share. Now, how we are going to choose between which alternative is best for the organization? If we have to choose, we'll go for the optimal one. And the optimal capital structure is the one which gives the highest EPS to the organization, right? Because increasing the EPS is ultimately the objective or the long-term objective of the organization. So we are going to evaluate that in each of the alternatives, what is the effect on the EPS of the company. And the one which has the highest EPS is the optimal one for the company to go for, right? So in all the scenarios, say in scenario 1 where the company is financing through 100% equity, the company has an earning before interest and tax of 1,50,000 and a tax rate of 30%. We computed that the earning available for equity share is 1,05,000. 5,000 shares company already has issued. Company is increasing 3,000 shares also. So in total company has 8,000 shares as of now. So the EPS in this scenario is 13.13. Likewise, we computed for the second scenario where the company is raising 1 lakh through equity and 2 lakh through debentures. In the second situation, the company has earning available for equity share of 91,000. So 2 lakh is by debentures. So considering 10% interest rate on debentures, the company has paid interest. So in the first scenario, interest was not there. Equity shares 1 lakh equity, so that is like 1000 equity plus 5000, which is already existing into the business. Total number of equity shares 6000. So EPS in this second scenario is 15.17. Third scenario, through 100% term loan. In this, since the company has raised, only increase the interest burden and the number of shares has not increased. The number of equity shares are 5000. So 84,000 is the earning available after equity share. EPS is 16.80. And in the fourth scenario, equity 1 lakh, preference 2 lakh. The dividend on preference shareholder is not tax saving, so that is just an appropriation of profit. So after earning after tax, we reduce the preference dividend, which is 16,000. Earning after available for equity shareholder is 89,000. Number of equity shares 6,000. 5,000 plus 1,000 raised. EPS is 14.83. So we all can note that in the third scenario, the EPS is highest. So in such a situation, the optimal capital structure for the company is by raising funds to 100% term loan. The next concept we are going to discuss is leverage. Leverage is basically derived from a word lever. So lever is basically an instrument which is used to lift a heavy object. You all have seen that a car got punctured and used a lever to lift that car, to pull that car. If without using that lever, you try to exchange the tire, how much efforts do it need? Obviously a lot of efforts, because you cannot pull the car by yourself. A lever is used to actually achieve that, is able to lift that car with a very small effort. So the effort in doing the work yourself and the effort with the help of lever is comparatively very less. So leverage is basically the way, or you can say leverage is computing the effect of that, you can say lever or you can say instrument. So in our example, in financial terms, this lever is the fixed cost. To explain further, example, you are working somewhere and the employer is paying you salary. So if you compare that salary with the revenue that the company is earning because of your efforts, which one is more? The revenue is more or your salary? Revenue, right? So company is paying you a peanut salary, and because of that salary, the company is earning a huge revenue. So because of that small effort, or you can say fixed cost, company has achieved a higher result. So leverage is using those fixed costs or the funds in order to increase the return to the shareholders. There are three types of leverage: operating, financial, and combined. I'll explain you all these three. So you all have seen that how we compute earning per share of a company. From sales, you reduce the variable cost. So cost is of two types. One is fixed cost, the other one is variable. Variable which got affected with the change or the variability in the sales. When you reduce that variable cost, we got contribution. From that contribution, we reduce the fixed cost. Fixed costs are also of two types. One is the operating fixed cost, that is those costs without which operations of a company do not run. For example, salaries to you. Salary is an operating fixed cost for that organization. Or you can say the rent that the company pay for the location. Without incurring this expense, company cannot operate. So such type of cost is called as operating fixed cost. So the fixed cost that I have reduced, 20 rupees, is the operating fixed cost for the organization. The other cost is the financial fixed cost for the organization. So financial fixed cost is interest, which is on the borrowings of a company. So if a company raises certain debentures or takes some debt, there is another fixed cost over the organization. This cost is called as financial fixed cost of the organization. So here that is 10 rupees is the financial fixed cost over the company. So the relationship between the contribution and EBIT, or the difference between the contribution and EBIT, is called as fixed cost. This cost is operating fixed cost. So operating leverage is a relationship between contribution and EBIT. Likewise, the difference between earning before interest and tax and earning before tax is interest. So the relationship between EBIT and EBIT is called as financial leverage. And the relationship between earning before tax and sales. So you incur two types of costs. Fixed cost and the interest, operating and the financial. So when we take the overall cost of the company, we call it as combined leverage. Let's discuss in detail one by one. Operating leverage is because of that operating fixed cost in the organization. Remember in the first lecture, in the nature and significance of financial management, when we were discussing, I told you about operating risk. Because if there is any variability in the return, or you can say there's a variability in the sales, the company has to bear that fixed cost. So this cost has created an operating risk over to the company. So operating leverage helps to measure that operating risk over the organization. Why? Because if we say that operating leverage is 1, that is, the contribution and EBIT is equal, they are same. Well, practically this is not possible, because it's never a situation that the company is not incurring any fixed cost. So there is no operating risk over to the company. Higher the operating leverage, so operating leverage is computed as contribution upon EBIT. If the operating leverage is high, we can say that the company has great operating risk, or you can say there is a high amount of fixed cost. That is because the operating leverage will increase. So operating leverage measures the incidence of this fixed cost on what? On the profitability of the business organization. If I have to compute what is the degree of this operating leverage, we can compute it by measuring the relationship between the percentage change in profits because of percentage change in sales. Why this operating leverage is computed? Because there are many benefits of computation of operating leverage. Operating leverage, first of all, it helps to compute that how much our change in their profits is there because of the variability in the returns. It helps us to identify the position of the fixed cost in the organization, the operating fixed cost in the organization. And third point, it helps the organization to understand that how much fixed cost should be invested into the business. Or you can say it also helps the company to understand that how much fixed expense the company is incurring, which has an effect on the overall contribution into the company. Right? Next is financial leverage. See, we all learned that financial leverage is a relationship between earning before interest and tax and earning before tax. The difference is interest. Interest again increase the financial risk over the company, because irrespective how much earnings the company has an obligation to pay that risk. So it creates a risk over the company. So financial leverage is a relationship between EBIT and EBT, and is computed as EBIT upon EBT. It is computing what is the incidence of financial fixed cost on the profitability of the entity. If we have to compute the degree of this financial leverage over the company, it could be computed as that how much impact, or you can say change in the taxable profit is there because of the change in earning before interest and tax. Mathematically, it is percentage change in EBIT upon percentage change in EBIT. So why we are computing this financial leverage? If we think of the uses are same. It helps to examine as to relationship between EBIT and EBT. Moreover, It helps the finance manager, the company, to locate what is the current profitable financial position of the company, how viable that capital structure is there for the company. Now, what if there, you can say EBT is zero? So when EBT can be zero, when your interest is just equal to EBIT, that means the company is earning sufficient enough or only that much amount that it can cover the interest expense of the company. That point is called as financial break-even point, because at that level the company is able to earn only the financial expense of the company, and the earning per share at that point is zero. Right? Now there's one more break-even point. What if the company EBIT is zero? That means the company contribution is just equal, or you can say is able to recover only the operating fixed cost of the company. That point is called as operating break-even point, because at that point your EBIT is zero, right? And the next one is combined leverage. So combined is combination of both operating leverage and financial leverage. It is computed as contribution upon EBT, because degree of operating leverage is computed as contribution upon EBIT. Financial leverage is computed as EBIT upon EBT. So DCL is computed as contribution upon EBT. So this is creating a relationship between the contribution and earning before tax. So there are two types of fixed costs in between contribution and EBIT. One is operating fixed cost, the other is financial fixed cost. So when the company measure the overall cost, fixed cost, or you can say the total risk, both the business risk and the financial risk on the company, we compute DCL in such a situation. In order to compute the degree, or you can say the extent of combined leverage, it is the percentage change in earning per share due to percentage change in sales. This is one example to understand this better. The following data is available for Balram Industries. Company has a sales of 2 lakh, variable cost at rupees 30, which is 60,000. So you can compute the number of units even for that. Well, that is not even required. Contribution is 1,40,000. Fixed cost is 1,40,000. So 2 lakh divided minus 60,000. Less 1 lakh. So EBIT is 40,000. Interest expense is 5,000. Basis which we computed that PBT is, or you can say earning before tax, is 35,000. Find out by what percentage which the taxable income increase if EBIT increased by 6%. What is the relationship between EBIT and EBT? The financial risk. So using financial leverage, we can actually compute the impact of the change in EBIT on the profitability of the company. Next is by what percentage will EBIT increase if there is a 10% increase in sales. And operating leverage has the impact on the contribution and EBIT. Using the information given in the question, the contribution is 1,40,000 and earning before interest and tax is 40,000. So operating leverage is 3.5. EBIT is 40, interest expense is 5,000. So earning before tax is 35,000. Financial leverage in this situation is 1.14. Right? So for the first scenario where we have to compute change in the taxable income because of some change in earning before interest and tax, we can use financial leverage because the difference between the two is interest. We already know that the financial leverage is 1.14, we just computed. So if there is 6% change in EBIT, there will be 6.84% change in the taxable income of the company. The second question is to compute the change in the EBIT because of 10% increase in sales. So operating leverage is the difference, or you can say your operating fixed cost is the difference between your sales and EBIT. So we'll use operating leverage in this situation. So 10 into 3.5, so there is an impact of 35% on the EBIT due to 10% increase in sales. That's all for today. Thank you so much.